Welcome to the Stock Market Palantir. Today we are going to talk about BFLY. Butterfly Network Inc., or BFLY, finds itself at really a critical inflection point after releasing its Q3 2025 earnings. The results were, well, they were complicated. You have this massive, almost jarring divergence between the headline gap numbers and what's actually happening underneath. And this is all going on while they're trying to pull off this huge strategic pivot toward AI and software.
It's a messy picture, for sure. And that complexity really brings up the fundamental question for any investor looking at BFLY right now. What are we supposed to be valuing? Do we look forward, at the potential for a high-margin AI and data platform, a view that's frankly supported by some much better unit economics and some serious insider conviction, or should we stay grounded in today's reality?
Exactly. And that's the core of our debate. I'm going to argue that the operational reality in this pivot, they create a really asymmetric opportunity that the market is just fundamentally mispricing right now because it's distracted by all the noise.
And I'm going to maintain that the gap reality, the numbers that hit the screen, and all that market noise that comes with it, well, that warrants a lot of caution. You can't just wish away a huge headline loss. The transition, even if it's the right move, it creates friction and a ton of execution risk that has to be priced in today, not tomorrow.
Look, for me, this whole thing rests on a forensic analysis of that Q3 report. Getting past the knee-jerk reaction to the stock price. While everyone was focused on the noise, the underlying operational reality was actually exceptionally strong. Let's start with resilience. Revenue came in at $21.5 million. That actually beat the consensus estimates, which were sitting around $21.2 million. And that stability was driven mostly by the adoption of their new probe, the IQ3, which sells for a higher price. But here's the most important number, the one that looks forward. The adjusted gross margin. It hit a company record high of 63.9%. We have to pause on that. That is a huge expansion from where it was, hovering around 60%. It shows the real economic potential of this platform once you strip out that one-time accounting mess. And maybe even more critically, the company is more financially stable than ever. They've got $144.2 million in cash, and the quarterly cash burn is down to a record low of just $3.9 million. I mean, at that rate, you're looking at a runway of over 7 years. The immediate risk of them needing to dilute shareholders it's just off the table. That fundamentally changes the risk profile here.
Okay, I see that. And, the cash preservation is absolutely commendable. I won't argue that. But let me give you the other perspective, the perspective of the broader market, of the trading algorithms, of the average retail investor who just reacts to headlines. The number that drove the stock down was the GAAP earnings per share loss of negative 13 cents. That was nearly double what Wall Street was expecting, which was somewhere between a 4 and 7 cent loss. A miss that big causes a violent, immediate reaction, no matter what the underlying reason is. And that miss was a direct result of the GAAP gross margin just collapsing to negative 17.5%. So what does that mean? It means they had to take a massive $17.4 million non-cash inventory write-off. Management can call it a strategic cleanup of old inventory, sure, but what they're really saying is they had a bunch of stuff they couldn't sell. That charge led to a GAAP net loss of $34 million. To an outsider, that just signals massive operational problems, and it feeds all the algorithmic skepticism. And on top of that, we can't ignore the very real issue of overhead supply. You have all these longtime holders who bought in during the SPAC craze, at $10, $15, even $25 a share. They're just waiting to break even. That psychological resistance, it's like a concrete ceiling that has to be smashed through before the stock can really move up in a sustained way.
Accounting strategy. A non-cash write-off it's an accounting entry. It doesn't mean $17.4 million walked out the door in Q3. It was a strategic choice to just formally impair the value of that older legacy IQ plus inventory. It's like cleaning out the garage, right? Management decided to clear out the old models, take the loss now, so they can focus all their resources on scaling the high-margin, higher-priced IQ3 platform. This move, it created headline noise, but it was necessary to clean up the balance sheet. It was a prerequisite for future clarity. So that 63.9% adjusted gross margin, the one that strips out that one-time loss, That is the undeniable true indicator of where the unit economics are heading.
That kind of expansion suggests the business has finally hit this critical operational leverage that comes from their chip-based tech. They're finally getting the manufacturing efficiencies the market has been waiting for.
See, I'm just not fully convinced by that line of reasoning because these retrospective accounting cleanups, while maybe they're rational in a vacuum, they inject a ton of volatility. And they distract from the main goal, which has to be generating positive, recurring cash flow. You're essentially asking the market to ignore what's happening right now for a promise of what might happen later. And while, yes, the adjusted margin is strong, the business is still fundamentally tied to the hardware cycle. You brought up Moore's Law dynamics, this idea that their chip costs will just keep falling over time, pushing margins even higher. But isn't that just a theory until it's proven? I mean, proven across multiple hardware cycles in different supply chain environments. Making medical devices isn't the same as making iPhones. The company still depends on constrained hospital capital budgets to sell these probes.
And that's a slow, cyclical, really tough sales process that burns cash regardless of any inventory write-off. So 63.9% is fantastic for a quarter, but we have yet to see if it's sustainable and, more importantly, if it can translate into real positive operating cash flow quarter after quarter.
That's a fair challenge. The hardware cycle inertia is real. However, the market has also received some very strong external validation signals that support management's cleanup thesis. We aren't just taking their word for it. Director Larry Robbins, the founder of Glenview Capital Management, we're talking about a deeply sophisticated institutional player here. He deployed about $6.78 million of his own discretionary money to buy shares on the open market. He snapped up 2.8 million shares right after that post-earnings dip, between November 19th and 21st. That is insider conviction at its highest level. When a highly informed operator buys into that kind of volatility, it sends a powerful signal. It says they see the drop as temporary and the long-term fundamentals as solid. And this isn't happening in isolation. You have broader institutional accumulation. Look at BlackRock. They increased their position by a staggering 258%, bringing their total stake to about 14 million shares. These big, sophisticated players aren't reacting to a headline EPS miss. They clearly get the cleanup story and are positioning for the recovery. It suggests the valuation floor is pretty close.
I just interpret those signals a little differently. While, okay, the Robbins buy is undeniably a significant vote of confidence, we also have to look deeper into the market's plumbing that was happening at the same time. You saw high dark pool short volume ratios. It spiked to over 56% on November 12th. Now, for our listeners, dark pools are these private exchanges where institutions trade huge blocks of shares off the public market. A high short volume ratio there often just means that market makers are shorting shares to instantly fill a big institutional buy order when they don't have the inventory. The implication is that the shorting is mostly just noise, a function of providing liquidity. It's not necessarily a directional bearish bet. So while you had huge underlying demand from guys like Robbins and BlackRock, the price action was getting stabilized, maybe even suppressed by these off-exchange mechanics. It just makes the signal more ambiguous.
It slows everything down. And on top of that, you have this persistent retail fear, these rumors, unfounded by the way, of an imminent reverse split. It's like this residual trauma from the 2024 non-compliance notice. Even though BFLY is totally compliant now, trading comfortably above $2, this misinformation just crushes retail demand. You need that retail conviction to sustain a move, and right now, it's paralyzed.
That psychological resistance is definitely a real factor, but that only reinforces the asymmetry of the opportunity here. The stock is being held down by noise and fear, not by a failing business. And the most crucial shift, the ultimate reason for investment, is this pivot to AI and data monetization. It just completely mandates a valuation re-rating that makes the whole hardware debate secondary. Let's talk about the licensing deal with Midjourney Inc. This is transformative. It's a $15 million one-time payment plus a $10 million annual license fee. Why is this so critical? Because it validates BFLY's proprietary ultrasound database, one of the largest of its kind in the world, as a valuable 100% margin data asset. This is a revenue stream that has nothing to do with selling probes. And this AI pivot is much broader. They've launched Compass AI, which automates documentation and billing, a huge pain point for doctors.
System allows BFLY to shift from selling a one-time product to selling high-margin, sticky, recurring software subscriptions. That transition justifies re-rating BFLY from a low-multiple hardware maker to a high-growth data platform. And the current $2 to $3 price just does not reflect that structural change at all.
That's a very compelling argument for a potential re-rating, and I agree. The data is their core moat. But have you considered the monumental execution complexity here? I mean, fully realizing that software dream it's a huge lift. The Midjourney deal is great, it's a nice cash infusion, and it's a one-time validation of the database's value. But it's not yet proof of a scaled, recurring data-as-a-service model across their whole customer base. The company has to overcome some historical skepticism from clinicians. Remember the early IQ Plus image quality issues? And there's a lot of friction in pushing a subscription model for advanced features onto busy doctors. Shifting your relationship with the hospital from being a simple vendor who sells a probe to being a strategic software partner, that takes a significant, long-term, and expensive effort. And they could face stiff resistance from the established IT integrators who are already entrenched in hospitals. So the valuation re-rating thesis, it remains high variance. It relies entirely on them successfully getting the software adopted at scale inside the clinical environment, which right now is speculative. We see the potential, sure, but the market is only going to reward it once they prove the adoption friction is gone and that the recurring revenue is really consistently compounding. It's an inflection point, yes, but they are not through it yet.
But that's exactly the point. The market always prices based on where a company is going, not where it's been. That massive runway, the $144 million, it gives management the luxury of time to execute this complex transition without being under pressure to raise capital. They aren't scrambling. They have the time and the money to address that skepticism and prove out the Compass AI model. The downside is hedged by the cash on the balance sheet. The upside is uncapped by the data monetization. We are buying the transition risk, yes, but the price of that risk right now is artificially low because of temporary accounting noise.
I understand the asymmetric argument. I do. But I'd counter that the market is pricing in exactly that execution risk, the risk of turning a great concept, a massive, valuable data set, into a consistently profitable software platform within the highly regulated and change-resistant healthcare system. They've shown they can make the hardware efficiently now. That 63.9% margin proves it. But now they have to prove they can sell sticky software at scale. And until that software revenue is clearly visible and growing, the stock is going to keep trading based on its hardware losses and its past psychological trauma.
That is a fair distinction, a very important one. We agree that the execution of the software pivot is absolutely paramount.
Absolutely.
So to summarize our discussion, the Q3 results, when you really dig in, they show the market is pricing BFLY based on retrospective accounting noise, that one-time $17.4 million write-off, and not on its powerful forward operational strength. That strength is evidenced by the record 63.9% adjusted gross margin and the validated data strategy with the Midjourney deal. The downside is largely mitigated by that $144 million cash runway, while the upside, which is driven by the AI pivot and strong institutional buying, positions the stock for an inflection point that the current valuation just fails to recognize.
And I think we fundamentally agree that the underlying technology moat is strong, and their operational discipline on cost and cash burn is impressive. However, the gap reality and that persistent retail and algorithmic skepticism mean the path to a re-rating is fraught with complexity. The market needs to see sustained proof that these AI revenue streams are genuinely additive and recurring, and that they're scaling enough to outweigh the drag from the hardware segment. They need to silence those persistent fears about liquidity and the stock's history. The material clearly presents BFLY as both a substantial risk and a genuine asymmetric opportunity. And it all depends on management's successful execution of this long-term software pivot.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.